I want you to imagine that you are standing on a platform watching this incredibly sleek, state-of-the-art bullet train just rocket past you.
Okay, yeah.
And the digital display on the side of the train is flashing these record-breaking speeds, right? Everyone on the platform is cheering. The engineering looks totally flawless.
Then you walk, maybe just half a mile down the tracks.
Exactly. You walk down the tracks and you see the actual structural foundation, right? The steel rails. They are warping under extreme heat.
Wow.
And the concrete pylons that are supporting the bridge ahead are actively just crumbling into a ravine.
That is quite the visual, but it really, it perfectly captures the tension we are analyzing today.
Right. You are looking at a system that is simultaneously breaking speed records and, well, suffering catastrophic structural failure. Welcome to the deep dive.
Thanks for having me. That visual of the warp tracks, I mean, this surface level momentum of global capital markets right now is completely divorced from the physical infrastructure underneath.
It really is. So just to set the stage for you listening, today is April 22, 2026. And our mission in this deep dive is to unpack what I think is one of the most profound head-spinning paradoxes in modern financial history.
Oh, without a doubt. It's totally unprecedented.
We have the S&P 500 and the NASDAQ hitting all-time record highs, right? They are pulling in capital at just a ridiculous rate.
The train is speeding up.
Exactly. But directly beneath that, the global economy is flashing these severe late-cycle warning signs, and there is this massive geopolitical chokehold that is just paralyzing the global energy supply chain.
Yeah, the plumbing is backing up.
To figure this out, we are synthesizing a really dense stack of source material today. We are anchoring this with the Convergence and Contradiction Comprehensive Analysis Report.
Which is fantastic, by the way.
Yeah.
Very detailed.
Yeah, it's incredibly thorough.
Yeah.
We're also pulling real-time dispatches from AP News, the Saxon Market Quick Take, Trading Economics, and ONDA Market Wraps.
So our goal here is to help you separate the headline indices from the internal, very granular realities of sector decoupling.
Right, because an index is just a number.
Exactly. A stock index is just a math equation,
Yeah.
It's a weighted average of corporate valuations. But the physical economy, the literal ships and factories, it's currently backing up in ways we haven't seen in decades.
We have to figure out if you are looking at a durable economic boom powered by all this tech innovation, or if it's just an optical illusion masking a really painful structural shift.
So before we look at stock tickers, before we analyze any yield curves, we have to look at the map.
Yes, let's start with the physical constraints dictating those global supply chains. Because this entire stock market rally is happening in the shadow of a massive physical blockade.
You really cannot interpret the financial data without mapping out the physical reality of the Strait of Hormuz right now.
It's the center of the board.
It is. The events unfolding there represent basically the ultimate supply-side shock to the global system.
So if you're looking at the AP news wires, this geopolitical choke point is dominating everything. President Donald Trump announced an indefinite extension of the U.S.-Iran ceasefire.
Right, and the sources note this extension was explicitly requested by Pakistani mediators.
Yeah, to give Tehran space to formulate what they called a unified proposal.
Unified proposal, right.
So the headline screams, diplomatic progress, or at least a pause in hostility. But the physical reality on the water is what the reports are calling a shadow blockade.
The shadow blockade. I mean, the U.S. is maintaining a stringent, unyielding naval blockade of Iranian ports and the Strait of Hormuz itself.
So the boats still can't move.
Exactly. President Trump emphasized that this naval posture remains locked in place until a final, comprehensive agreement is signed.
And obviously, Iran is not happy about that condition.
Not at all.
Yeah.
Iran's parliament speaker, Mohammad Bagher Ghalibaf, stated publicly that a ceasefire is entirely meaningless while the blockade persists.
And this fracture, this gap between the diplomatic posturing and the military reality on the ground, that is where the economic crisis really begins.
Yeah, because we are seeing a severe internal disconnect within Iran itself. The Islamic Revolutionary Guard Corps, the IRGC, they are acting completely independently of the civilian negotiating team.
Which is terrifying for global trade. So the diplomats are in these rooms discussing ceasefires, but the IRGC's naval units are actively seizing commercial vessels.
Right. The Convergence and Contradiction report details the actual mechanics of this shadow war. The IRGC successfully seized the Liberian-flagged Epaminondas.
Wait, Epaminondas?
Yeah, Epaminondas. And the Panamanian-flagged MSC Francesca.
These are not small boats.
No, these are massive commercial vessels.
Yeah.
And they were intercepted while attempting to transit the strait and forcibly divert it toward the Iranian coast. And
Unbelievable.
a third vessel, the Euphoria, was actually fired upon and only narrowly escaped.
Wow. So the scale of the energy shock this creates, it is difficult to overstate. The Strait of Hormuz isn't just a shipping lane. I mean, it is the central artery of global energy.
It is the choke point.
So we are currently looking at roughly 200 massive oil tankers stranded. 200.
Yeah, they're either anchored outside the Gulf refusing to enter, or they're trapped inside unable to leave.
The best way to visualize this ceasefire, for you listening, is to think of a boxing referee stepping in to stop a brutal fight, right?
Okay, I like this analogy.
He stops the fight, but then he locks the doors to the arena and turns off the water supply. So, yeah, the punches have officially stopped landing, but the fighters and the audience are now just suffocating.
That is exactly what is happening. The math on the stranded crude is just staggering.
What are the exact numbers on that?
Well, the cumulative loss of oil production reaching the global market has topped 500 million barrels.
500 million barrels.
And the current trajectory is pushing toward 1 billion barrels of lost supply.
Wow. And the market didn't just ignore that?
Oh, the market reaction was instantaneous.
Yeah.
Brent crude completely shattered the $100 per barrel psychological threshold.
Right, which everyone watches.
Yeah, it was sitting at $101.62 on the morning of April 22.
So the ripple effects of this supply shock are just tearing through the global economy. I mean, the International Energy Agency, the IEA, issued this blaring warning that Europe has only 6 weeks of jet fuel left in its reserves.
6 weeks. It's nothing. Which brings us to the concept of demand destruction.
Oh, man. Demand destruction.
Yeah, it is a very clinical economic term for a very brutal real-world phenomenon.
Right, it sounds like an accounting error, but it's really not.
No, not at all. The sources indicate that roughly 5 million barrels of oil demand per day is currently being destroyed, primarily in Asia.
But just to clarify for the listener, demand destruction does not mean consumers suddenly decided to bike to work, right?
Or that factories decide to become more eco-friendly? No.
Right. It means the physical commodity is simply unavailable, or the price has spiked so high that the underlying economic activity is no longer viable.
Exactly. The factory literally cannot afford to run the machines, so it shuts down.
The airline cannot secure the jet fuel, so the flight is canceled.
And nations across Asia are implementing extreme emergency measures. We are seeing government-mandated export bans on refined petroleum products.
Just hoarding whatever they have.
Yeah, and countries are burning through their strategic, highly polluting coal reserves just to keep their electrical grids from completely collapsing.
Wow. It is basically an amputation of industrial output just to survive a localized energy famine.
It is.
But wait, I have to ask, if 5 million barrels of industrial and consumer demand are just gone, and if Europe is literally counting down the days until commercial aviation grinds to a halt,
Yeah.
how is the global economy pretending this is fine? How is the macroeconomic data supporting these stock prices?
Well, the tension between that macroeconomic illusion and the real-time physical reality, that's the defining theme of the April data drops.
The surface data looks okay.
On the surface, sure. But the physical reality of 200 stranded tankers directly bleeds into the economic reality of the American consumer.
Okay, let's dig into that consumer data then.
When we look closely at the data, it starkly contradicts the prevailing narrative of a seamless soft landing.
Yeah, so the Business Conditions Monthly Report for February 2026 was finalized on April 22, and it shows the U.S. economy clearly losing its post-war momentum.
Losing momentum fast.
The leading economic indicator, the LEI, hit 46.
Right, and an LEI reading of 46 is historically very significant.
For those who don't track the LEI daily, what goes into that 46 number?
So the LEI aggregates metrics like building permits, factory orders, and the stock market to forecast where the economy is heading 6 months from now.
Okay.
And a reading of 46 is a traditional, reliable signal that the economy is transitioning out of expansion and moving towards stagnation or even outright contraction.
But the surface-level news paints a rosier picture, right? United States initial jobless claims actually dropped 7%.
Yeah, people are still working.
And adjusted retail and food services sales rose 0.7%. So if you only read the headlines, you see low unemployment and rising retail spending. You think, hey, the economy's great.
But you have to look at the structural foundation beneath those top-line numbers, and the foundation is showing severe rot.
Where's the rot coming from?
Well, while jobless claims dropped, housing starts dropped 3.4%.
Oh, that's a big one.
Huge. Housing starts are a massive economic bellwether. When developers stop breaking ground on new homes, it signals a collapse in long-term capital investment.
Right, because a house is a 30-year bet on the economy.
Exactly. It shows deep pessimism about future consumer demand.
And speaking of consumer demand, the University of Michigan Consumer Expectations Index also dropped 0.7%.
Yeah, people are feeling the pinch.
But the most glaring red flag to me in this whole report is the inventory to sales ratio dropping 1.5%.
That is a critical data point.
Right, because think about it. If I am a manufacturer or a regional manager for a massive retail chain and my inventory to sales ratio drops sharply, it means I am terrified.
You're terrified of holding the bag.
Exactly. I am terrified of getting stuck with warehouses full of flat-screen TVs or washing machines that nobody can afford to buy.
So what do you do?
I am actively canceling wholesale orders and hitting the brakes on the supply chain to protect my margins.
Your reading of the inventory drop is spot on.
Yeah.
Businesses are basically hoarding cash and shedding inventory risk.
Which flows right into the rest of the data.
It does. This defensive posture aligns perfectly with the roughly coincident indicator.
What does that one track?
That tracks the here and now of the economy, industrial production, employment, and income. And it registered a very weak 17.
17. That's bleak.
Yeah. The Conference Board coincident manufacturing and trade sales slipped 0.1%, and non-farm payrolls were essentially flat.
But the metric that seems most dangerous for a U.S. economy that relies on consumer spending for, what, 70% of its GDP?
Roughly 70%, yeah.
It's the income data. Personal income less transfer payments fell 0.4%.
Right, and just to be clear, that means the actual money people earn from working.
Not government assistance.
Correct. That fell, and the Consumer Confidence Present Situation Index dropped 2.5%.
So wait, this is where we have to reconcile the conflicting data. If retail sales are up 0.7%, doesn't that mean people are still buying things?
Well, the Saxo Market Quick Take report provides the crucial missing puzzle piece here.
Okay, because the math isn't mathing.
Exactly. How can personal income drop and consumer confidence plummet while retail sales supposedly rise super 0.7%? The answer is inflation illusion.
Inflation illusion.
Yes. That 0.7% aggregate rise in retail sales was driven overwhelmingly by a massive 15.5% jump in gasoline station receipts.
Oh, wow. A 15.5% jump just on gas.
Exactly. People are not buying more goods. They are not upgrading their appliances or going out to nice restaurants.
They are just swiping their credit cards at the gas pump and paying a 15% premium just to commute to their jobs.
Yes. The actual volume of goods moving through the economy is stagnant or shrinking, but the nominal dollar amount looks like growth because the cost of the underlying energy has just skyrocketed.
So the American consumer is basically trapped in a momentum deficit. I mean, the wealth effect generated by the S&P 500 hitting record highs, that disproportionately benefits the top 10% of asset holders.
Overwhelmingly so, yes.
But it provides zero relief for the bottom 90% who are absorbing the daily reality of $100 oil, higher utility bills, and completely stagnant real wages.
And the bond market is seeing all of this. The bond market, which is generally viewed as the smart money.
Because it deals in hard math.
Right. It deals in hard mathematical probabilities rather than equity narratives. The bond market is screaming that a slowdown is coming.
How so?
The 1-year to 10-year U.S. Treasury yield spread narrowed sharply by 40.4%.
40.4% is a massive move. Let's unpack the mechanics of the yield curve for a moment to understand why this matters to the listener.
Sure. So the 1-year Treasury yield is heavily influenced by the Federal Reserve current interest rate policy. It reflects the cost of money right now.
Right.
The 10-year Treasury yield, on the other hand, reflects the bond market's collective forecast for economic growth and inflation over the next decade.
Okay, so normally the 10-year yield should be higher than the 1-year yield, right? Because investors demand a higher return for locking their money away for 10 whole years.
Exactly. You want a premium for that time risk.
But when the curve inverts, when the 1-year pays more than the 10-year, it means money is tight right now. But the market expects a recession to force rates down in the future.
Correct. And a narrowing of the spread, especially an abrupt 40% narrowing like we just saw, means the dynamic is shifting violently.
The bond market is looking past the artificial glow of the equity markets.
Yeah, it's looking at the physical energy shock, the stranded tankers, the demand destruction in Asia, and the shrinking inventory orders.
And it is pricing in a long-term structural degradation of economic growth.
Precisely. Which brings us to the entity tasked with actually managing this collision between inflation and stagnation.
The Federal Reserve.
Yes. With energy costs driving inflation back up and the consumer buckling under the pressure, the market is suddenly waking up to a major regime change in central banking.
A huge regime change. April 22 marks the definitive arrival of the Warsh era.
Kevin Warsh.
Yeah, the confirmation hearings for Kevin Warsh, the nominee to succeed Jerome Powell as Federal Reserve Chair. This served as a profound shock to global capital markets.
It really did. Because Warsh laid out a completely new monetary orthodoxy. He didn't use the usual vague central bank speak,
No, he was incredibly blunt.
very blunt. His core thesis, the quote that really rattled the trading desks, was inflation is a choice.
Inflation is a choice. He explicitly warned that the Fed has a very short window to fix prices before inflation expectations become unanchored in the minds of consumers and businesses.
The philosophical weight of that phrase, inflation is a choice, it really cannot be overstated.
Because it goes against everything the market relies on.
Right. For the last 15 years, the prevailing belief on Wall Street was the Fed put.
The safety net.
Exactly. The idea that if the stock market fell too far, or if the labor market wobbled even a little bit, the central bank would rush in, slash interest rates, and pump liquidity into the system to save asset prices.
They chose maximum employment and asset growth and basically tolerated the resulting inflation.
But Warsh is declaring that era over. By saying inflation is a choice, he is saying the Federal Reserve has actively chosen to let the cost of living rise to protect the stock market in the past, and he intends to make a very different choice.
He is signaling that he will prioritize price stability for Main Street, even if it triggers a brutal sell-off on Wall Street or raises unemployment.
And he detailed the mechanics of this shift during the hearing.
What did he lay out specifically?
Well, he favors a significantly smaller central bank balance sheet, and he explicitly stated he wants to avoid purchasing long-term U.S. Treasuries.
He also took a firm stance on central bank independence, right?
Yes, he directly denied that President Trump had demanded any commitment to future interest rate cuts as a condition for his nomination.
Okay, so for the listener who is just trying to pay their mortgage, what does a smaller balance sheet, avoiding long-term treasuries, actually mean for their wallet? We have to translate this balance sheet talk into real-world mechanics.
Absolutely. So when the Fed was engaged in quantitative easing, they were creating reserves to buy massive amounts of long-term treasuries and mortgage-backed securities.
By stepping into the market as a guaranteed multi-trillion-dollar buyer, the Fed artificially suppressed the yield on those bonds.
Right. And because the yield on a 10-year treasury serves as the baseline for consumer credit, the Fed's buying spree directly pushed down the cost of a 30-year mortgage, a 5-year auto loan, and corporate debt.
So they basically subsidized the cost of borrowing for the entire economy.
Exactly. So when Warsh says he wants to shrink the balance sheet and avoid buying long-term treasuries, he is outlining the mechanics of quantitative tightening.
Which means
The Fed lets those bonds mature. The Treasury pays the Fed back. The Fed then effectively destroys that capital, draining liquidity out of the commercial banking system.
wow. And with the Fed no longer acting as the buyer of last resort, the market has to absorb all that new Treasury debt itself.
And to attract buyers, the yields must go up.
Right. And when Treasury yields go up, the mortgage officer at your local bank immediately raises the interest rate on your prospective home loan.
Warsh is telling the market that the era of subsidized borrowing is entirely over.
And the markets reacted with immediate violence to this, didn't they?
Oh, absolutely. The 10-year Treasury yield surged to 4.31%, which is its highest level in over a week.
And the 2-year.
The 2-year yield, which tracks near-term Fed policy expectations almost tick for tick, that spiked to 3.80% before finally settling at 3.76%.
And this hawkish pivot didn't just rattle domestic bond markets, right? It triggered a massive, highly disruptive global currency realignment.
Yes. When U.S. interest rates rise, global capital naturally floods into the United States to capture those higher risk-free yields.
And this massive inflow of capital drives up the value of the U.S. dollar against foreign currencies.
The U.S. dollar firmed up aggressively across the board, but the impact was particularly devastating on the Swiss franc.
Let's talk about the Swiss franc, because the USD to CHF currency pair jumped to the 0.78 level.
Yeah, the situation facing the Swiss National Bank, the SNB, is a perfect case study in how U.S. monetary policy dictates global outcomes.
Because Switzerland is historically an ultimate safe haven destination for capital.
Usually, yes. But their domestic economy is currently experiencing near negative inflation.
So normally, a central bank facing deflationary pressures would dramatically cut interest rates, right? They would print francs and buy foreign currency to artificially weaken their own money, making their exports cheaper and importing some inflation to stimulate the economy.
That's the textbook play. But the S&B is completely trapped.
Because of Warsh.
Because of Warsh and the strong dollar. The U.S. dollar is strengthening rapidly due to its hawkishness. Simultaneously, the Swiss franc had previously reached these historic, suffocating highs against the euro.
And Switzerland is a massive exporter of high-value goods.
Right. Pharmaceuticals, precision manufacturing, luxury watches. So a strong currency makes their products prohibitively expensive on the global market.
The survey data on Swiss manufacturing is just catastrophic.
What are the numbers there?
11% of Swiss firms surveyed explicitly stated that exporting to the United States is no longer profitable at current exchange rates.
11% are already underwater.
And it gets worse. If the exchange rate hits the 0.70 level, a staggering 50% of Swiss firms say their U.S. exports will be entirely unprofitable.
Wow. Half their exporters.
So the S&B cannot cut rates deep enough in a negative territory to weaken the franc without destroying their own banking sector. But if they do nothing, their export economy faces a wave of bankruptcies.
It's an impossible situation. So we have established a thoroughly bleak macroeconomic landscape here.
To put it mildly.
We've got a physical blockade destroying 5 million barrels of oil demand daily, an American consumer surviving on credit to buy expensive gas, a Federal Reserve architecting higher borrowing costs, and global currency markets fracturing under the weight of a dominant U.S. dollar.
Which brings us crashing back into our central paradox.
Right, the record highs.
Exactly. Given every single catastrophic data point we just walked through, how on earth did the S&P 500 and the NASDAQ manage to close at all-time record highs on April 22?
It defies logic.
The S&P 500 closed at 7,137.90, up 1.05%. The NASDAQ hit an astonishing 24,657.57, surging 1.64%.
The answer is that the indices are lying.
Lying.
Well, or rather, the mathematical weighting of the indices is obscuring a violent, historic decoupling happening beneath the surface.
But we are no longer looking at a broad bull market.
Not at all. We're witnessing an extreme polarization. It's the hardware boom versus the software bust.
Let's unpack the hardware boom first. It's driven entirely by the physical infrastructure of artificial intelligence, right?
Basically, yeah. The AI on everything narrative. The Philadelphia Semiconductor Index marked its 16th consecutive day of gains.
16 days.
Yes, that is the longest winning streak in the entire history of the index.
Wow. And looking at individual winners, Micron Technology surged 8.48% in a single day, hitting a record $487.48 a share.
It's parabolic. And Texas Instruments absolutely crushed their bottom line estimates, delivering $1.68 in earnings per share versus the $1.38 Chiefs expected.
And the stock rocketed 8% after hours, so capital is flowing exclusively toward the foundational layer of the AI revolution.
Because building, training, and running these large language models requires an unfathomable amount of physical compute power.
It's not magic, it lives on servers.
Right. It requires massive data centers, specialized cooling systems, dedicated power grids, and millions of advanced semiconductor chips.
The market recognizes that this physical infrastructure is an absolute, unavoidable bottleneck. It is a capital expenditure supercycle.
But the moment you look away from the physical chips and look at the software sector,
it is an absolute bloodbath.
It really is.
The Software and Services Index is down 13% year-to-date. ServiceNow, which is a titan of enterprise software, they plummeted 14% after hours.
What was their reasoning?
They blamed margin squeezes from acquisitions and deal delays in the Middle East due to the conflict.
Right, the blockade effect.
And IBM dropped 7.4% after reporting that growth in its highly touted Red Hat Cloud unit slowed down to 11.3%.
So the underlying mechanism driving this software sell-off is the sudden realization of AI disruption risk.
Meaning the old business models are dead.
Yeah. The fundamental value proposition of a legacy software company, a Salesforce, a Workday, an Oracle, it was the moat.
Right. They provided complex software ecosystems that businesses integrated into literally every department.
Exactly. And once a Fortune 500 company trained 10,000 employees on a specific software interface and migrated all their data into that specific silo, the switching costs were astronomical.
You couldn't leave even if you wanted to.
Right. The software provider had total pricing power and essentially collected a permanent tax on the business.
But the sources point directly to the launch of advanced AI tools by firms like Anthropic in February 2026.
Those tools changed everything.
They did. These tools are natively automating complex data analytics, workflow optimization, and marketing.
The AI basically breaks the moat. If a company can deploy an AI agent that understands natural language, interacts directly with raw databases, and generates custom code or reports on demand.
The proprietary software dashboard becomes entirely obsolete.
Exactly. The enterprise no longer needs to pay a $50 million annual licensing fee for legacy software if an AI model can perform the exact same functions natively at a fraction of the cost.
The dynamic here, it really reminds me of the building of the Transcontinental Railroad.
Okay, I see where you're going with this.
Right, so the semiconductor companies, the Microns and NVIDIAs, they are the steel foundries and the rail companies. They are laying the physical tracks across the country.
Yep.
It requires hundreds of billions of dollars in upfront capital, but they hold an absolute monopoly on the physical pathway.
And the software companies.
The software companies are the equivalent of the stagecoach lines. For decades, the stagecoach was the only way to move information and value. They had immense power.
But suddenly, they're looking out the window.
Exactly. They are watching the steel tracks being laid down and realizing that the train isn't going to partner with them, it is going to make them extinct.
The market is pricing in exactly that extinction event. Investors are rotating capital aggressively out of software companies with high multiples and evaporating moats and plowing it directly into the hardware monopolies.
And it isn't just a tech story. The divergence extends all the way down the market cap spectrum. The Russell 2000, which tracks small cap domestic companies, is up 5.57% year to date.
Which is wildly outperforming large caps.
Right. Large caps are barely clinging to a 0.56% gain outside of the AI hardware giants.
So what's driving the small cap resilience?
The strategists attribute the small cap resilience to the One Big Beautiful Bill Act.
Ah, the stimulus package.
Yeah, a domestic fiscal stimulus package pumping money into local economies, which is insulating these smaller firms from the broader global energy and currency shocks.
This creates a hyper-fragmented, K-shaped market environment.
Extremely K-shaped.
Mega-cap hardware companies are soaring on AI infrastructure spending. Small-cap domestic companies are grinding higher on fiscal stimulus. Legacy software is collapsing under the threat of automation.
And the traditional consumer sectors are suffocating under the weight of the physical energy blockade.
To really understand how volatile this environment is for individual companies, we need to look at specific sector spotlights.
Right, because this K-shaped divergence isn't purely technological. When you examine corporate earnings outside of tech, you see how heavy-handed regulatory risks and direct government interventions are creating extreme winners and losers overnight.
The healthcare sector is basically a minefield of regulatory exposure right now. The political landscape shifting underneath these companies is rewriting their balance sheets in real time.
Let's look at Elevance Health. They serve as a prime example of surviving the minefield, but barely.
They raised their guidance, didn't they?
They did. They managed to raise their full-year earnings guidance to $26.75 per share, projecting some confidence. However, they were forced to take a staggering $935 million accrual.
Wait, almost $1 billion?
Yes, almost $1 billion, specifically for potential Centers for Medicare and Medicaid Services, or CMS, regulatory exposure.
So they had to sideline nearly $1 billion in capital, simply to brace for a potential regulatory penalty.
Exactly. If you miscalculate the regulatory environment, the consequences are terminal.
And Molina Healthcare demonstrated this brutally.
Their GAAP net income collapsed by 95% year over year.
95%. That is completely catastrophic.
It plunged to a mere 27 cents per share. A 95% wipeout in net income for a major healthcare provider is a catastrophic failure of the business model. What exactly triggered that collapse?
It was driven predominantly by a massive $93 million impairment charge.
Related to what?
Related to their decision to completely exit the Medicare Advantage Part D product line for the upcoming 2027 plan year.
So they just walked away.
Yeah, an impairment charge means the company had to admit to their shareholders that the assets, the contracts, and the infrastructure they built for that specific division are now essentially worthless.
Why did it become worthless?
The regulatory environment surrounding prescription drug reimbursements became so hostile, or the premium caps became so restrictive, that Molina calculated it was mathematically impossible to operate the division profitably.
So they chose to amputate the limb rather than let the losses infect the entire company.
Exactly. Now, contrast that regulatory bloodbath with Boston Scientific.
Oh, they had a great week.
They surged nearly 9% on the back of purely organic, strong cardiovascular medical device sales.
So if you pick the right subsector, you win big. But as unpredictable as healthcare is right now, the aviation sector is where the market's internal logic truly fractures.
Aviation is the tip of the spear for the global energy shock. Airlines have absolutely zero ability to substitute jet fuel, If the price doubles, their operating margins are immediately decimated.
Which we saw with United Airlines. They saw their shares drop 5.58% entirely due to the margin squeeze caused by the $100 Brent crude and the physical shortage of refined jet fuel.
They are caught in the gravity of the physical blockade.
But the most shocking development in the sector revolves around Spirit Airlines. And we are reporting the facts of this development exactly as documented by the Wall Street Journal and Bloomberg.
Yes, the situation surrounding Spirit Airlines is a defining moment for government intervention in the current economic cycle.
So Spirit Airlines stock, trading under the bankruptcy ticker FLYYQ, suddenly soared 143% in a single day, hitting $1.50 a share.
143% on a bankrupt airline.
Yes, this explosive rally occurred because reports confirmed that the Trump administration is nearing the finalization of a $500 million bailout loan to rescue the carrier.
Spirit has faced 2 bankruptcies in 2 years and was teetering on the edge of total liquidation.
And the mechanics of the bailout are highly unusual. To secure this $500 million taxpayer lifeline, the federal government would receive equity warrants.
Which means?
If exercised, these warrants would grant the U.S. government up to a 90% ownership stake in the airline.
So the federal government is effectively nationalizing a failing budget airline.
That's what it looks like. The sources report that this initiative is being spearheaded by Commerce Secretary Howard Lutnick and Transportation Secretary Sean Duffy.
And what is their rationale for this?
They state their rationale is that allowing a major, ultra-low-cost carrier to liquidate would remove so much capacity from the market that the remaining legacy airlines would enact massive, anti-competitive price hikes on critical domestic routes.
Which would further fuel consumer inflation.
Exactly. Meanwhile, Southwest Airlines is navigating the exact same energy shock, but reported the highest adjusted net margin among all large U.S. airlines.
How did they manage that?
They achieved this through ruthless operational discipline, pivoting toward high-yield business revenue, and capping their capacity growth at a strict 2%. Southwest managed the crisis. Spirit failed. But Spirit is receiving the capital infusion.
I have to challenge the overarching logic of the market here because it feels entirely contradictory.
It really does.
In the first half of this deep dive, we established that the Federal Reserve, under Kevin Warsh, is cementing a new era of strict, orthodox free market capitalism.
Inflation is a choice.
Right. The Fed is stepping back, shrinking the balance sheet, and letting the market price debt without a safety net. If a legacy software company gets disrupted by an AI startup and loses 50% of its market cap, the government does not care.
No, that is the creative destruction of the free market.
That is the technological reality, yes.
But simultaneously, the executive branch of the government is utilizing a $500 million loan to essentially acquire a 90% stake in a chronically failing budget airline to artificially suppress ticket prices.
It's completely wild.
How is an institutional investor supposed to allocate capital in a system that is ruthlessly Darwinian when it comes to technology, but aggressively interventionist and, frankly, socialist when it comes to transportation?
You are describing the reality of a heavily financialized, politically sensitive economy operating under immense geopolitical stress.
Okay, make sense of it for me.
The market is being forced to differentiate between idiosyncratic risk and systemic political risk.
Okay.
If a software company fails to adapt to AI, it destroys shareholder value, sure, but it does not cause a spike in the consumer price index that voters feel on a daily basis. It is an idiosyncratic failure.
I see. But a sudden 40% spike in airline tickets because Spirit liquidated, that is a systemic political problem.
Precisely. Investors must now operate as political analysts. They have to map out which sectors the government views as critical infrastructure, like airlines, semiconductors, domestic energy.
And which sectors are left completely to the mercy of the free market.
The interventionist floor exists, but only for industries whose failure would generate unacceptable political or inflationary fallout.
Wow. So with the United States market behaving so erratically, swinging wildly between record AI highs and government bailouts, international capital is desperately trying to find stable ground.
We have to look at the global scorecard to see how the rest of the world is processing the U.S.-Iran blockade and the Warsh Fed.
Yes, the international data reveals the true cost of this U.S.-centric policy divergence. Let's examine Japan.
Japan is fascinating right now. The Nikkei 225 achieved a massive historical milestone. It briefly crossed the 60,000 mark for the first time ever.
60,000, that's huge.
This surge was propelled by better-than-expected first-quarter growth of 1.7%, which was heavily reliant on the export of advanced computer chips and semiconductor manufacturing equipment.
So Japan is successfully riding the exact same AI hardware supercycle as the United States.
But the Nikkei's triumph was incredibly short-lived. The index retreated sharply almost immediately upon crossing the threshold.
Why the sudden drop?
It was driven entirely by fears regarding the stalled U.S.-Iran peace talks and the reality of the shadow blockade.
Ah, right. The contrast is fascinating. Japan dominates the high-tech export market, but their entire industrial base is profoundly vulnerable
Very vulnerable.
because Japan imports virtually all of its energy. They can design and manufacture the most advanced AI chips on the planet, but if the Strait of Hormuz remains blockaded and the oil tankers cannot reach Tokyo, the fabrication plants cannot operate.
The Nikkei's rapid retreat demonstrates how fragile a tech boom is when it lacks domestic energy security.
And Europe's situation is even more dire, isn't it?
Yes. The reports characterize the European environment as energy stagnation. The blockade is hitting them directly.
What are the numbers out of Germany?
Germany, which is the historical industrial engine of the European Union, just halved its 2026 economic growth forecast down to a meager 0.5%.
0.5% growth.
And simultaneously, they raised their inflation outlook to 2.7%, explicitly citing the geopolitical war shock pushing up the cost of raw materials and energy.
That is the textbook definition of stagflation. The economy is barely growing at 0.5%, but prices are rising at nearly 3%.
And in response to that stubbornly high inflation, the European Central Bank is forced into a hawkish posture, much like the Fed.
So they're raising rates too?
They are expected to raise the deposit rate to 2.50% to cool prices, which is just going to further suffocate that already anemic 0.5% growth.
Unsurprisingly, the major European equity indices, the DAX in Germany, the CAC 40 in France, the STOXX 600, they all closed lower.
Europe is absorbing the physical brunt of the energy shock without the insulation of the AI hardware boom.
So we have a global landscape where European equities are stagnating, the Japanese market is retreating on energy fears, the U.S. bond market is pricing in long-term damage, and the U.S. stock market is being carried entirely by a handful of semiconductor monopolies.
It's precarious.
Where does institutional capital hide when the entire board is flashing warning signs? It flows into the ultimate historical sanctuary: gold.
Gold, yes. The commodity supercycle is the quiet, massive force dominating 2026. Gold settled at an astonishing $4,751.01 an ounce.
Wow.
That absolute number is staggering, particularly when you consider it surged 60% in 2025 alone. But the raw dollar price of gold is actually the least interesting metric.
Right. The true story is relative value. You are referring to the Dow to gold ratio.
Yes.
The comprehensive report specifically highlights this metric, noting that the ratio currently sits at 10.4 to 1.
And to understand the gravity of that number, we have to explain exactly what the ratio measures and why its collapse over the last 8 years is so significant.
The Dow to gold ratio is basically a mechanism for measuring the true purchasing power of financial assets, right?
Yeah.
It cuts through the illusion of inflation.
Exactly. To calculate it, you simply take the numerical value of the Dow Jones Industrial Average, which is hovering around 49,490 right now,
Okay.
and you divide it by the price of 1 ounce of gold, which is roughly $4,750. The resulting number, 10.4, tells you exactly how many ounces of physical gold it takes to buy one nominal share of the Dow index.
Okay, so just to give people context, in 2018, the Dow to gold ratio peaked at 22 to 1.
22 to 1.
It took 22 ounces of gold to buy the Dow. Financial assets were supremely valued compared to hard physical commodities back then.
Exactly.
Yeah.
The collapse from 22 to 1 in 2018 down to 10.4 to 1 today reveals a massive hidden bear market.
Hidden because of the nominal highs.
Yes, the TV anchors are celebrating the Dow Jones hitting record highs in nominal U.S. dollar terms. But the U.S. dollar itself has lost so much purchasing power that the actual intrinsic value of the stock market is plummeting relative to hard assets.
So if you measure your wealth in ounces of gold rather than fiat currency, the stock market has essentially been cut in half over the last 8 years.
And historical precedent makes this even more alarming. During the most severe economic crises of the 20th century, like the depths of the Great Depression in the 1930s or the peak of the stagflation crisis in the late 1970s,
What happened to the ratio then?
the Dow to gold ratio collapsed all the way down to 3 to 1, or even a 1 to 1 parity.
Wow. The institutional money flowing into gold today is betting that this cycle has much further to run.
Absolutely. The market is recognizing that printing trillions of dollars over the last decade artificially inflated the stock market, and we are now experiencing a violent reversion to the mean where hard, tangible assets reassert their historical value.
And we are seeing structural bids supporting other precious metals as well. Silver, platinum, and palladium are all elevated.
Very elevated.
But the most alarming anomaly on the trading screens right now is the simultaneous rise of both gold and the US dollar.
That is the real red flag.
Normally, these two assets operate on a strict seesaw dynamic. Gold is priced in dollars. If the US dollar strengthens, it takes fewer dollars to buy an ounce of gold, so the price of gold typically falls.
Right.
And if the dollar weakens, gold rises.
That inverse correlation is a bedrock principle of currency markets. The US dollar is the ultimate fiat safe haven, backed by the taxation power and the military might of the United States.
And
Gold is the ultimate non-fiat safe haven, carrying absolutely no counterparty risk and relying on no government for its value.
so if both the US dollar and gold are surging at the exact same time, breaking that historical seesaw relationship,
Yes.
isn't that the financial equivalent of a smoke alarm going off in the background while the band is still playing at the party?
That is exactly what it is. It is the ultimate signal of extreme systemic geopolitical fragmentation.
It shows real fear.
When both the dollar and gold rise together, it tells you that global capital is absolutely terrified. It is abandoning emerging markets. It is fleeing the stagnation in Europe.
It is looking at the shadow blockade in the Middle East and deciding that no yield is high enough to justify the risk.
Capital is desperately flooding into the only two remaining lifeboats: U.S. Treasuries, for those who still trust the Federal Reserve and the U.S. government, and physical gold, for those who trust nobody at all.
Trust the Fed or trust nobody. That is the binary choice defining global finance on April 22, 2026.
It's a stark choice.
As we pull all these disparate threads together, the energy shock, the Warsh era, the tech decoupling, the government interventions, what is the definitive takeaway for the listener trying to navigate this landscape?
The overarching conclusion from this deep dive is that the very concept of the stock market is dead.
Dead.
The era of buying a broad, passive index fund, closing your eyes, and relying on general economic growth to lift your portfolio is entirely over.
The rising tide is gone. We have transitioned permanently from a stock market into a pure market of stocks.
Every allocation of capital now requires surgical precision. You must distinguish between the durable hardware monopolies building the physical infrastructure of the future and the vulnerable software incumbents whose profit margins are evaporating under the threat of AI automation.
You really have to know what you own.
You must differentiate between healthcare companies navigating complex regulatory mandates and those suffering 95% income wipeouts from a single policy shift. The macroeconomic environment is too hostile to support broad, untargeted growth.
And the resilience of this fragmented market is about to face a severe stress test.
Very soon.
Looking ahead, all eyes are on the April 24th data releases, the final Michigan consumer sentiment readings, and the flash PMI data for both the U.S. and Europe.
That data is going to be pivotal.
It will reveal if the momentum deficit is finally cracking the American consumer. It will show us if the reality of $100 oil and a hawkish Fed is finally pulling down the record valuations of the S&P 500.
Or if the AI hardware boom has enough gravity to keep the indices suspended in midair. The tension between the leading indicators flashing red and the headline indices hitting records cannot persist indefinitely. A reconciliation is coming.
I want to leave you with a final provocative thought to mull over until our next deep dive. Throughout this hour, we've extensively mapped the massive hardware boom, right?
The semiconductor supercycle.
Fueled by the insatiable demand for AI compute power. Investors are treating companies like Micron and Texas Instruments as bulletproof monopolies because physical chips are the unavoidable bottleneck for AI.
But consider the long-term trajectory of the technology itself.
The evolution of the software layer. Right now, AI models require millions of specialized chips to process massive, inefficient data sets.
Right.
But what happens when the AI systems cross the threshold where they begin writing, refining, and optimizing their own code?
That's the billion-dollar question.
What happens when a next-generation LLM discovers a mathematical shortcut that allows it to process 1 billion parameters using only 10% of the compute power previously required?
It is the paradox of exponential efficiency. The software becomes so intelligent that it optimizes away the need for the hardware.
Exactly. If AI software makes computing infinitely more efficient, the physical hardware bottleneck disappears.
And then what?
Will the massive multi-trillion-dollar semiconductor supercycle eventually cannibalize itself? If an AI breakthrough suddenly renders 90% of current server farms unnecessary, the demand for physical chips will evaporate overnight.
The pickaxe seller.
Right. The current giants of the market, the companies selling the pickaxes for the AI gold rush, might suddenly find themselves sitting on mountains of excess silicon that nobody needs. The bullet train might look unstoppable today, but if the destination suddenly moves closer, you don't need the tracks anymore. Something to mull over. Until next time.